So, Mark Anthony, here we are. We are in February. People are gathering their tax papers, getting ready to reach out to their accountant, to their CPA, because it is, it's tax season. I don't know why. I didn't mean to make it scary for people. Like, I didn't mean it that way. I meant it as people are getting ready. This is that time of year that everybody's getting their tax documents ready to go to see their accountant, to see their CPA. And I have been receiving a lot of questions. Now, again, I'm not a CPA. I'm not an accountant. But I do get a lot of questions. And I'm thinking to myself, David, since it is tax season, why didn't you think to have a trusted accountant or CPA on the show? What? You know what, Mark Anthony? Let me just quickly take that call.
Yeah,
and
sure.
I'll be right back.
Go for it.
Okay, let me pick up here. This is David Crossan on the lighter side of finance.
David Crossan, it's Chris Whale, and I heard over the airwaves that a CPA was needed, so I've swooped into action.
Ooh, look at that. It's like he put on his cape, he flew right in here. Thank you very much, Chris Whalen, CPA. I appreciate you calling into the show.
Of course, good morning and tax season here.
Well, it is tax season. And Chris, let me come at you with just a couple different questions from people that I work with that are saying to me, you know, David, I've sat down with my CPA, I've sat down with my accountant, and my refund is lower, and they're asking me to talk about the changes that have occurred with the tax laws that, you know, maybe this is going to be something that they can expect lower returns, and they were questioning me, why is that the case? Why are their returns lower? And again, this isn't for everyone that I'm speaking to, but I have had people reach out to me because their tax returns, the rebates that they're used to, are lower. Can we talk about that, Chris?
Sure. It's a common thing that's happening, and I want people to realize that a lower refund does not mean that you're actually paying higher taxes at all. 95% of the time, we're finding that's not the case. So what's happening in brief is that last year, when the tax reform was instituted, a lot of the payroll tax tables at your payroll companies or at your company were changed to reflect the changes, which were lower rates and broader brackets. So people actually had more money in their paycheck last year than they did the prior years. That's important to remember. So, but many people relatively had too low of a tax withheld. So that's why at the end of this year, when they're applying those credits, right, what you had withheld against your taxes, your refund is lower. But what I want people to really take a look at before they get alarmed is if that tax reform has hurt them, I want them to look at the amount of tax that they're actually paying this year, the tax, not the refund, against last year, and see if it's equal or if it's a lower number, and especially if you have wages that were high. Check out what is your effective tax rate, and then see how much was your withholding this year as opposed to last year. And you may be surprised, oh, look, my withholding was much less. Of course, my refund is lower. So overall, most people still have had a great impact from tax reform, where they've had more money in their pocket, even if their refunds are less this year.
Chris, if I'm hearing you correctly, so what you're finding is for a lot of people that are getting lower refunds this year, actually in their paychecks have been getting more money. In other words, they're not paying as much, but when it's coming time for their filing, because they're not withholding enough during the course of the year, that seems to be one of the reasons why people are getting a lower refund?
Exactly.
Okay, that's fair. And again, everybody's unique, everybody's different, but it just seems to be a conversation that a lot of people are coming to me with, and that makes a lot of sense. So people really need to take a look at the previous year, look at what was paid out and their refunds compared to what actually, and of course the tax, compare it to what's going on now, and that really would be a fair comparison to see dollar for dollar what's going into their pocket?
Right, and if you do have someone preparing your taxes, it is a very it's a normal question to ask that person. Hey, can you explain to me the mechanics, the nuts and bolts of what went into this refund this year? What exactly happened, and in exactly the kind of terms I just explained. So, what is my new tax? What was my tax last year? What is my gross taxable income? So, any preparer should get to the point where you really understand, oh, is my refund, is it lower because my tax is higher? So you should be able to be comfortable, at least to know exactly why this happened. If not, please call my office and you can bring everything to me. I will explain to you pretty quickly by looking at your supporting documents what happened.
All right, that's fair. Chris, I'm just going to shift gears to SALT deductions and explaining what they are, the new limitation that's now in effect, and any impact that you're seeing on people when it comes to how much they're able to afford on, say, a primary real estate purchase.
Right. So the SALT deductions are the state and local income tax deductions. So that's gross income tax you pay out of your paycheck to New Jersey. It's also property taxes. Now, those two categories combined cannot exceed $10,000 on your Schedule A or your itemized deductions. Now, in high tax states such as New York, New Jersey, and California, that can be a problem, right? Because we have high income taxes and high property taxes. So many of my clients are seeing a limitation. Now, of course, if you look at that in a vacuum, that could, of course, increase your taxes. If you think about it, if I had $20,000 of SALT deductions last year and now I only have $10,000, well, that decreases my deductions by $10,000, and that means it increases my taxable income by 10. So, of course, you would have an increase in tax. But many people that had those deductions in prior years were an alternative minimum tax, which did not include the SALT deductions. But also there are other changes in the law in terms of rates coming down, which are significant, and margins that are moved to a higher level that offset that. So that's very important. That doesn't necessarily mean you're going to have higher taxes if you have a limitation on your SALT deductions. The other thing that was troubling is that everyone was concerned, especially real estate agents, in that the property tax deduction is intrinsic to the value of property in any state, so especially in high tax states. So people were concerned, well, if now a buyer of real estate thinks that I'm going to have a limitation on this deduction, right, that would mean that it might hurt the value. But the mindset should really be is, what is my after-tax income? What is this buyer's after-tax income? And are they able to afford the house after tax reform overall? And I think most people will see, at least in my estimation, that most people can afford the same house or a larger house after tax reform when all of the changes and nuances are calculated.
See, that's a great point to bring up, because what you're talking about here is that limitation on the $10,000 that people may be thinking, well, I don't have the ability, maybe my taxes are $20,000, I can only write off the $10,000, but you bring in a valuable point where those particular people that may have been subject to AMT with now a raised threshold may not be subject to that and actually puts more money in their pocket. Am I hearing you right?
Right, exactly. There are some people that had $20,000 of SALT deductions, but technically didn't get them because for the AMT calculation, they're added back. So now they might get a SALT deduction of $10,000 because they're no longer an AMT. So again, there's so many changes to the law that are positive that everyone really needs to have it evaluated the right way and explain to them, and also then explain to their real estate agent and lender and underwriting, so everyone can. I don't want the people that are holding real estate now to feel at a deficit suddenly because of this, because I believe come the spring, we're going to have, once tax season's over and people can see the reality of what their true after-tax income is now, which is going to be higher, that there's going to be a bigger seller's market for real estate, especially homes in New Jersey, come this summer.
That's an interesting point, and I'm glad you brought that up. And of course, we're not here to predict what the real estate market is going to do or not do, but you're bringing up some valuable points, because I believe for a lot of people that was the fear, because of that $10,000 limitation, it would have a negative impact on areas in real estate that have higher taxes. But when you bring up that point with the AMT and that raised threshold, then it either could even out or possibly be more of a benefit to those particular individuals. And I appreciate you even bringing that up, because that was actually something I wanted to talk about on the show today. But I'm going to shift gears a little bit, Chris, and let's talk about the current child tax credit.
Right. So the child tax credit, it was $1,000 for a child that was 16 or under at the end of the year. And what we have is an income limit, though. So let's say a married couple, made $110,000 or more, and they weren't eligible to get a child tax credit. So that number was very low, and that hadn't been increased in a long time. A lot of middle income families make a lot more, they make more than that, and they weren't getting it. So what the tax reform does, it actually increases that limit to $400,000, approximately $400,000. So now, if you have a child under 16 or under at the end of last year, then and you're a couple now and you make 400,000, you can get a $2,000 child tax credit. So I just want people, especially those who are doing their taxes themselves, who never really had a child tax credit, they might not be thinking about this or that they're eligible. They might skip it. Or if you have a tax preparer, if you go to a tax preparer that's more of a fast food kind of tax preparer, they might be also rushing through things to get things done in front of you for 15 minutes. And please, I ask everyone, do not go to a tax preparer that sits there and does your taxes in front of you and has you leave in 20 minutes. There's no way it can be done correctly. We need to have it done in the office and reviewed by CPAs. So please make sure you go to someone that has a system in place where you can have it entered and reviewed and then gone over with you. If you get your taxes done in one sitting, most likely there could be problems and there's not enough there's not enough time and effort put into making sure it's accurate.
Chris, we talked about this time that you were on the show, and now this is in effect, and it's regarding short-term rentals. And a lot of clients I have, and I'm sure that you have as clients, have a second home, maybe a home at the shore where they may rent weekly or, by the month or whatever it may be. But now there is a tax on short-term rentals. Can we talk about that?
Sure. As of October 1st of 2018, if you have a rental in New Jersey, not just down the shore, that's 90 days or less, and it's subject to sales tax and occupancy taxes. It's that simple. So there are some exclusions if you do use a real estate broker in some way. There are some rules. I have some really good memos on my website for this. But anyone that has a question should really reach out to me because this is a very serious thing. There's a lot of misinformation out there. But if you have a rental, a lease, even if you have a house you rent, not down the shore, where you don't have a firm lease for over 90 days, then that is subject to sales tax and occupancy tax now. So a lot of people have renters for many years. They let the leases go. It's month to month, but the state can come back and audit you for that, and you are going to be you're going to have to pay the prior state the sales and occupancy tax that you failed to collect.
So whatever the rent is that you're getting, and let's say somebody has been doing a month to month, now for that dollar amount, they're going to be subject to a sales and occupancy tax for whatever is collected.
Exactly.
Okay, well, that's important because we do have a lot of people that do have homes. And you're right, it doesn't have to be at the shore. The reason I brought that up is, a lot of people may have places that they rent out during the summertime, but it could be anywhere in the state of New Jersey that they may have a month-to-month where they could be subject to this. And it's very important to talk about it, especially if you're in that particular situation, to talk to your trusted CPA accountant for that. Chris, I just wanted to shift gears, if we could, before the show wraps up, on with the new tax plan, the impact that this is having on small businesses.
Right. Well, there's a great deduction now called which is for qualified business income, and if you remember, Trump gave a corporate tax break to large corporations, and of course that was good that he did that because we had fallen behind, and we were some of the highest corporate tax rates in the world. When decades ago we were some of the lowest and friendliest. So he gave a corporate tax break to large companies, but also he wanted to help small business. So many small businesses can now get a 20% reduction in their taxable income on their business income if they're under certain total income limits. So that's important to remember that if you're a Schedule C and you make $100,000, you could possibly only pay tax on $80,000. But remember, this does not affect self-employment taxes that self-employed people pay. that's a mistake I'm seeing already that other preparers are making. So you can, if you're eligible for the qualified business income deduction, that's 20% off the taxable income on your ordinary tax. It does not impact your self-employment tax.
And on your website, Chris, and before you go, I want you to mention how, number one, people can get a hold of you if they're needing some assistance, and also just talk about your website, because on your website you do have different examples of different situations like we're talking about today, or other situations for tax filings that people can go and look at to have an example of something they may be dealing with.
Yes, I urge everyone to go to my website, which is chriswhalencpa.com, and that Whalen is Whalen. There's a memos page there, which has a lot of very useful and informative information. I never put out anything that's just to sell you something or bait and switch. So please go to that page, and you'll see many, many things that impact individuals and all of us, as I say, that are working at the street level. I have a media page where I post my interviews such as this one, my presentations that I do for various groups. I share that for free. So check out the media page also.
And Chris, one more time, your phone number for anybody who would like to reach out to you that may have questions or need some assistance.
Yeah, please call me directly on 732-673-0510. I want to just make a quick thank you to my great team, Anthony, Renee, Zach, Chelsea, and Dan, and Jacob. That's my team this tax season, and I couldn't do it without them. They're all working right now as I'm doing this interview. So,
Chris,
thank you to them.
Chris, thank you so much for being on the show. Really appreciate the information, and thank you everybody for listening. My phone number 732-657-3089, or of course you can go to my website www.davidcrossan.wfadv.com. Go on there, look at different articles and videos on investment and estate planning strategies. Have an amazing week, and let's talk next time. Take care.
The Lighter Side of Finance is a paid program. The views and opinions expressed in this program do not necessarily represent the views and opinions of the staff and management of this radio station or Town Square Media, LLC. The purpose of the program is to provide information only. Any financial transaction can only be recommended by a knowledgeable professional who is familiar with your financial situation. Wells Fargo Advisors, LLC is a registered broker-dealer and a separate non-bank affiliate of Wells Fargo and Company.
Beach Radio 1160, 1310, and mybeachradio.com. Now, from the WOBM Newsroom, this is Beach Radio News.
It's 29 degrees. I'm Zineb Binu, Beach Radio News. Governor Murphy has declared a state of emergency for all 21 counties. It's in effect right now ahead of the storm, and 2,500 plows and salt spreaders are standing by this morning. The DOT is warning of a winter weather congestion alert and urging motorists to stay off the road this afternoon. Get all the latest updates about today's storm at mybeachradio.com. A 13-year-old Central Regional was brought to Community Medical Center Tuesday morning for a minor injury after the school bus he was riding on was struck by a Seaside Heights garbage truck near Grant Avenue. The school bus was struck on the rear passenger side bumper area while it was sitting at a red light at the intersection. 13 other students and the driver were on board. No other injuries are being reported. The accident remains under investigation. The NJ Sharing Network reports a record number of successful organ transplants in the state during 2018.
Network head Joe Roth says there were 678 life-saving transplants in the state during the year.
Usually a liver and 2 kidneys, but we've been very fortunate to be able to recover more hearts and also lungs that can help save additional lives.
Roth says of the typical organ donor,
New Jersey citizens who suffered non-survivable head injuries who have indicated their wish to become organ donors.
He says you can have the conversation about organ donation with family and friends and get more info at njsharingnetwork.org. In Trenton,